Sensitivity analysis. Concept and purpose. Sensitivity analysis is a vital tool in project appraisal and decision-making, used to measure how sensitive a project's outcomes are to changes in key assumptions. It identifies the variables that exert the greatest influence on net present value, NPV, internal rate of return, IR, or other financial indicators. The process involves adjusting one variable at a time, such as sales volume, unit price, or discount rate, while keeping others constant, to observe the effect on project outcomes. This approach provides management with insights into potential volatility and identifies the parameters requiring the most careful monitoring or control. CIMA emphasizes that sensitivity analysis is not merely a forecasting technique but a means of evaluating risk exposure and improving decision robustness. By quantifying uncertainty around key drivers, organizations can better prepare contingency plans and prioritize risk management efforts. Quantification of risk through sensitivity analysis. Sensitivity analysis translates qualitative risk perceptions into measurable financial outcomes. It quantifies risk by calculating how much a given change in a variable will affect project value, often expressed as a percentage or sensitivity coefficient. For instance, a 5% decline in selling price may reduce NPV by 20%, indicating high sensitivity and therefore greater risk. This quantification aids in distinguishing between controllable and uncontrollable risks, allowing management to focus resources on the most critical factors. CIMA notes that risk quantification enhances decision-making transparency, as stakeholders can visualize the magnitude of uncertainty. Moreover, the analysis supports investment prioritization under capital rationing by identifying projects resilient to variable changes. However, its limitation lies in varying only one factor at a time, which may oversimplify interdependencies among variables. Probabilistic extensions and scenario analysis. While traditional sensitivity analysis alters one variable at a time, probabilistic models allow simultaneous variation of multiple factors. Monte Carlo simulation, for example, assigns probability distributions to uncertain variables, such as demand, cost, and inflation, and calculates a range of possible outcomes. This produces an outcome distribution rather than a single-point estimate, allowing managers to assess expected values, variances, and confidence intervals for NPV. Scenario analysis complements this by evaluating coherent sets of assumptions, e.g., best case, worst case, and expected case. Probabilistic sensitivity analysis provides a richer understanding of risk, as it captures interactions between variables. It enables risk managers to visualize the likelihood of achieving target returns, supporting more informed and defensible investment decisions. CIMA regards these advanced techniques as essential for strategic risk evaluation in dynamic environments. Stress testing of projects. Stress testing extends sensitivity analysis by evaluating project performance under extreme or adverse conditions. It challenges optimistic assumptions to test project resilience against shocks such as sudden cost inflation, demand collapse, or exchange rate volatility. By simulating worst-case conditions, managers assess whether projects remain financially viable or require redesign. Stress testing is particularly relevant for long-term capital projects where macroeconomic changes can drastically affect performance. It helps identify break-even points, where NPV equals zero, thus defining the boundary between profit and loss. This form of sensitivity analysis supports risk mitigation planning, such as negotiating flexible supply contracts or hedging against currency risks. In line with CIMA's guidance, stress testing strengthens corporate governance by ensuring decisions consider downside risk exposure, not just expected outcomes. Managerial application and decision-making. In practical terms, sensitivity analysis informs managerial decisions by clarifying trade-offs between risk and return. For example, if a project's NPV is highly sensitive to price fluctuations, management may invest in market research or long-term contracts to stabilize revenue. Conversely, if input costs are the main sensitivity driver, cost control initiatives become priority. The results also guide resource allocation among competing projects. Those with stable outcomes may be prioritized under uncertainty. Sensitivity analysis enhances negotiation leverage by quantifying acceptable risk ranges and helps justify investment proposals to stakeholders. Nonetheless, CIMA cautions that sensitivity results depend on the accuracy of underlying data and assumptions, reinforcing the need for iterative review and robust data validation processes. Limitations and integration with broader risk tools. Although valuable, sensitivity analysis has limitations. It assumes variable independence, ignoring the combined effects of simultaneous changes, a condition rarely true in complex systems. It also fails to incorporate probability weighting, meaning it identifies which variables matter most but not how likely their changes are. Consequently, sensitivity analysis should complement rather than replace probabilistic risk analysis or scenario planning. Integrating it with decision trees, Monte Carlo simulations, and real options analysis provides a comprehensive framework for uncertainty management. Within CIMA's framework, sensitivity analysis forms the first step of a structured risk appraisal process, highlighting key drivers that are then subjected to deeper stochastic or strategic evaluation. Its true strength lies in supporting proactive management dialogue about uncertainty and resilience.